Where does real wealth actually come from? Not your salary, not your flashy lifestyle. It comes from money that grows on its own. Today, I'll show you the 3 most powerful ways to grow wealth: stocks, real estate, and crypto. Broken down simply so you can start even if you're a beginner. Reality check. Most people think promotions or raises will make you rich. Reality: salaries plateau. Inflation eats away savings, and your money stops growing the moment you stop working. Wealth doesn't come from what you earn, it comes from where you put your money. Vehicle number 1: stocks. Definition: stocks are small pieces of a company you can buy. Companies grow, you grow. Benefits: dividends plus capital appreciation. Even small monthly investments compound over time. Example: $100 a month in a stock index fund at 10% annual growth equals $50,000 in 20 years. Reality check. Stocks aren't gambling if you invest for the long term. Time is your best friend. Vehicle number 2: real estate. Rental properties. Collect rent equals monthly cash flow. Appreciation. Property value increases over years. Example: buy a small rental, rent covers mortgage plus extra equals passive income that grows automatically. Reality check. Real estate builds wealth quietly. It may require effort up front, but pays off for decades. Vehicle number 3: crypto basics. Crypto is digital assets built on blockchain. Examples: Bitcoin, Ethereum. Potential: high growth, early adoption rewards. Risk: volatile. Never invest money you can't afford to lose. Reality check. Crypto is a tool, not a get-rich-quick scheme. Proper knowledge and caution equals opportunity.
Compounding is the secret weapon of the wealthy. It's not about making big wins overnight. It's about letting small, consistent actions snowball into massive results. Here's how it works. Imagine you invest $200 every single month into an index fund that averages 10% a year. After 10 years, you'll have around $38,000. Nothing crazy, right? But wait. Keep going for 20 years, suddenly that grows to about $137,000. Stick with it for 30 years, you're looking at over $380,000. And remember, you only put in $72,000 of your own money. The rest, compounding, did the heavy lifting. The wealthy understand this. They don't panic when investments look slow in the beginning because they know the real magic happens later. Compounding is like planting a tree. It's small and unimpressive at first, but one day it shades your entire garden. Punchline: compounding is slow at first, but unstoppable later. Don't underestimate it. Now, most people fail at building wealth not because they don't make enough money, but because they keep repeating the same mistakes. Let's break down the biggest ones. Number 1, chasing trends instead of principles. The new hot thing gets you nowhere. Number 2, confusing liabilities for assets. A car you bought with a loan, liability. A house that cost you more in mortgage and taxes than it brings in, liability. Remember, assets put money in your pocket, liabilities take money out. Number 3, panic selling during downturns. Markets crash, always have, always will. The average investor loses because they sell low and buy high. The wealthy buy during downturns. Number 4, lifestyle creep. You get a raise, and instead of investing, you upgrade your car, your house, your lifestyle. Suddenly, your expenses rise as fast as your income, and your freedom doesn't grow at all. Reality check. Markets don't beat you. Inflation doesn't beat you. Your own habits beat you. And the punchline: wealth isn't lost in bad markets, it's lost in bad behavior. At the end of the day,
why do you even want wealth? For most people, it's not about cars or mansions. It's about freedom. Freedom to spend your mornings with your kids instead of stuck in traffic. Freedom to take that trip without begging your boss for time off. Freedom to say no to things that don't align with your values. Stocks, real estate, and crypto aren't just about numbers going up. They're vehicles to buy back your time, the only currency you can't earn more of. Here's the truth. Wealth without freedom is just another kind of prison. I've seen people earning $200,000 a year, but trapped in golden cages. No time, no energy, no joy. And I've seen people earning far less, but with smart assets, they control their time fully. Who's richer? Money is a tool. Freedom is the goal. Let's take a step back and see what history teaches us about building wealth. Generations of the rich didn't just get lucky. They followed proven principles over centuries. Number 1, stocks and compounding aren't new. The Dutch East India Company in the 1600s was the first public company. Investors who held shares for decades saw their wealth grow exponentially. Compounding worked then, and it works now. Number 2, real estate builds generational wealth. Families in Europe and America have passed down rental properties for hundreds of years. Even small plots bought centuries ago have appreciated massively, proving that real estate is a timeless wealth vehicle. Number 3, early adopters win. Merchants and railroads, tech stocks, or today's new innovations, the ones who act early often become the richest. Early action consistently beats waiting. And lastly, number 4, lessons from mistakes. History is full of financial collapses. Tulip mania, the 1929 stock crash, the dot-com bubble. But the wealthy survived because they diversified, invested in real assets, and stayed disciplined. History repeats itself, but the principles of wealth don't. Learn from the past, apply it today, and your money grows while others chase trends.
When it comes to building wealth, the first question is, where do you start? It depends on 3 things: your risk tolerance, your time horizon, and your knowledge. For beginners, start with stocks or ETFs, slow, steady growth. For intermediates, add real estate, stable cash flow, long-term appreciation. For advanced or risk takers, explore crypto, high risk, high reward. Many beginners put everything into crypto and then panic sell. The key isn't jumping in blindly. The key is balance and learning first. Now, the real power comes from combining these vehicles. Diversify. Don't put all your eggs in one basket. Example strategy: 50% in stocks for long-term growth, 30% in rental property for cash flow and appreciation, 20% in crypto for high risk, high reward. Reality: diversification reduces risk and smooths growth over time. Mindset shift: think like the wealthy. Wealthy people don't just save, they allocate and grow. They focus on assets that compound and generate cash flow, not flashy items or short-term thrills. Your money should work for you, even while you sleep. Action steps: 1. Pick one vehicle to start investing in this month. 2. Learn the basics thoroughly before committing money. 3. Track growth and reinvest profits consistently. Final reality check: salaries stop. Assets don't. Where you put your money today determines your freedom tomorrow.